Treasury Secretary Steven Mnuchin has said the absolute last day to raise the debt ceiling is September 29, after which the U.S. would be in default. Here is no historical parallel to assess how a failure to raise the debt ceiling before the drop-dead date would affect the economy, he wrote. Of course, economic history is littered with sovereign defaults, with hugely damaging results. However, those examples are invariably of countries that made the decision that continuing to meet their obligations was unbearably costly, not cases where the ability to pay was not in question but was held up by political maneuvering. Fairly reiterates that it is impossible to quantify the impact of a default. But he identified 5 ways it could hit the economy and financial markets. What is notable is that many of the effects impact financial markets and institutions rather than directly affect the real economy, Farrelly noted. However, as the Lehman Brothers experience of 2008 vividly reminds us, shocks originating in the financial sector can leave deep and long-lasting scars in the real economy. The market reaction would be swift and violent in the extreme scenario. Farrelly thinks the market response would be so substantial that policymakers would have no choice but to act fast. In the hypothetical scenario of a technical default, it would presumably be cured quickly, he said. This presumption is partly a function of the signal that financial markets likely would send to the political class. After all, the 2011 debt ceiling crisis did not entail a full-blown technical default, and even that caused stocks to sell off almost 20%. Given the centrality of Treasury securities in the financial system, even a quickly cured default could be a major shock to that system which would reverberate in the real economy, he said. Because of the enormity of the potential costs, we expect Washington will raise the debt ceiling in a timely manner. Sam Ro is managing editor at News Pulse Finance.